Hey all, good morning. It's 23rd of April and it's a Saturday, therefore we have the Saturday edition. And today's topic is why are genomic stocks languishing? So let's examine this. Let's get started. The overall market is selling off, especially for assets like growth assets like genomics and technology, basically because of risk of conditions. What do I mean by risk of conditions? So when a risk of condition happens, at the first level, participants, that is the investors like you and I, fear reducing future returns as interest rates raise a few basis points. And at that time, what the market does, it responds by discounting future earnings, and therefore the PE ratio gets reduced and the share prices fall. So this is the first level of anxiety, which is first level of manifestation of risk of behavior. In the second level, what happens is the participants are now afraid of losing their capital. They flee to bonds or other assets like gold. This leads to further sucking out of money from the market, and this leads to huge drops in indices. So this is the second level. And there are various level of fears that happen day to day. Leading up to that, someday the fear is very high, you see 3% drop, and someday the fear is low and you kind of go sideways. Someday there is some optimism, like the Tesla results came in, airline results came in, there's a spike, and then again it comes down. So overall, the market is reacting to risk and it is trying to take risk off its balance sheet, and that's the reason of the behavior. These varying levels of fears are caused by some of the following, or in combination, a few of them. The first one is the interest rate hike that will discount future earnings. So the way we look at discounted future earnings is that if you're earning $100 today as dividend, and if the interest rate goes up by 1%, that means the $100 you have today is going to be worth $99 tomorrow, because 1% interest is taking away the purchasing power. So this is also called fancifully by some commentators as demand destruction. Because when you lose that $1 purchasing power, your ability to demand goods is reduced by $1. So your demand is being destroyed by 1%. That is one of the factors that is happening out there. Other is a hostile Fed policy. When a Federal Reserve comes out and says that they're going to do anything and everything possible in order to control inflation, that is their top priority, and that 50 basis point hikes or even 75 basis point hikes are on the table. Those are all very hawkish statements, and that I would classify as a hostile Fed policy. Hostile not towards people, but hostile towards inflation. The third one is a pessimistic economic outlook. When interest rates are going up, the break-even point for new ventures becomes that much more challenging, and therefore it's a much more riskier proposition, so fewer ventures get started. So that's one way of looking at pessimistic economic outlook. Another way of looking at pessimistic economic outlook is those grand ventures and big projects do not take off because financing makes it very, very expensive. Let us say, for example, Elon Musk is trying to send a rocket to Mars, and that's going to cost a lot of money. And he was able to do all of those things under low interest regime. Building gigafactories, 3 gigafactories built in a very short span of time, all because of very low interest rates. When interest rate goes up, all these projects appear very expensive. And if these projects are expensive, then whatever comes out of those projects as products or services are also going to be expensive because they have to recover the cost. At the same time, as I explained in point number 1, there is demand destruction taking place. So ability of consumers to pay that kind of money for those goods and services is much reduced. As a result, most of the venture capitalists and people who are doing cutting edge projects decide not to do those things. So the economic outlook becomes more pessimistic because people think this project won't succeed economically and financially, it was not going to succeed. So let's not do it. And that's what happens in that kind of environment. Again, it's a manifestation of a risk of condition where an entrepreneur says that even if I was able to pull things off and even if I put all this money and effort into it, my product will be too expensive and people are not going to be wealthy enough to afford it. So that's pessimistic economic outlook. Bleak corporate forecast for future earnings, because even if the company has the same number of subscribers, paying the same amount of fees, the market is going to look at the income coming the subsequent year as discounted future income, and therefore the share price will drop. So corporate forecast from that point of view will not look appetizing for the shareholder. Another way the corporate forecast would be bleak is the ability of a company to increase the price of its products in order to recover inflation related costs that it had in its raw materials or building blocks of the product or service. And this in turn results in suppression in the market for the company's products, and therefore outlook for lesser earnings in the subsequent years. This is one way it would happen for many participants in the market. However, there are some companies which have got absolute control over their pricing. Companies like say Ferrari or companies like Apple, they have much better control over their sales price, and clients clamor for their products. They will have much less impact from this kind of a market condition. So that's what I would explain as bleak corporate forecast for future earnings. And when these future earnings are given, the market participants decide not to keep those shares with them anymore, and they sell it. And therefore the share price comes down, and they are taking risk of their balance sheet. Economic downgrades, when economists say that the expansion of the economy is going to be less, it directly translates to the fact that some companies are going to do less business than the others, and therefore the share price has to go down. Fear of recession is another thing. When interest rate keeps going up, the exchange rate becomes more favorable for cheaper imports, and domestic production goes down, as a result of which there is a loss of jobs. And when the loss of jobs take place and economy becomes weak, the currency doesn't remain as strong, and therefore imports become more expensive, and therefore you have inflation along with falling employment, unless the Fed steps in and does corrective action to boost employment. So there is always a fear of recession when the economy is overheated and the Fed starts tightening the interest rate. So these are all the factors. And some of the other factors are geopolitical risks, like the Russia-Ukraine conflict right now, the proposed oil embargo with Russia that's going to come from the European Union, the sanctions that are preventing Russia from participating completely in the economy, or for that matter from Iran from participating in the economy. Then there is the technology barriers. US doesn't export certain technology to certain companies, so to certain countries and companies in certain countries. So those things also kind of put a damper. And of course, you have the trade wars, which was started earlier, the China trade war. That's also causing a lot of problems. You can see that in the listed companies, Chinese listed companies in Nasdaq, and they are having a tough time right now. And that has prevented them from gaining their full potential. Companies like Neo, Alibaba, they are great companies, but they are struggling basically because of this trade war and the hostility between the two countries. Whenever there's a regime change, that brings about a lot of different approaches towards economics as well as towards foreign relations and trade. All those things cause problem, and this happens whenever there's a change in leadership. When US changed from Trump to Biden, there was an overall change in the outlook of US and the countries that it was friendly to and the countries that it was not, and also the way it approached trade. And likewise, before Erdogan took over Turkey, it was a different Turkey. And afterwards, it became a different Turkey, and which has got hyperinflation and all those things right now. And likewise, there are changes that happen in the leadership of countries. And if it's a significant country, it has got significant impact on the world economy. Remember, the housing market is very frothy in United States right now. Thanks to COVID migration and excess house building and raising interest rates, it's a volatile cocktail ready to explode. We'll examine that also in this video. And finally, economic risks. Sovereign default is likely. Pandemics may take place maybe again in another couple of years. Right now, we are riding through one. So all of those things also have impact of causing a risk of sentiment. Okay, we have already spoken at length about other aspects which are causing risk of conditions in the market. Now let's look at the housing part. For that, I want to show you this extract from the Fed Reserve balance sheet, and our attention should go to the mortgage-backed securities. which is the third last line here. But if you look at the black fonts and the third last line from here, mortgage-backed securities, we are almost 2.7 trillion worth of mortgage-backed securities in the Fed balance sheet. According to Fed's own reports, from February 14, 2022 to March 11, 2022, the last purchase of additional MBS took place, which means after March 11, 2022, there will be no more purchase of mortgage-backed securities. Most likely, there would be a turnaround by the Fed where they would probably say that they want to sell mortgage-backed securities going forward in order to reduce their balance sheet. If that happens, there is going to be additional pressure on the mortgage market. So to explain mortgage-backed securities, what happens is mortgage originators, they club together high quality mortgages and they convert it into a security and they sell it off to the Federal Reserve. The Federal Reserve buys that and gives the money back to the mortgage originators so that they can go and lend to other people and create new mortgages and create new mortgage-backed securities and sell it to the Fed. That's the way the system works. If this kind of a lubrication is not there, it will be very difficult for banks to create new mortgages because their money is already stuck on the mortgages that they have already given. This is the dynamic. So if the Fed stops buying mortgage-backed securities, that means banks are doing their last bid of mortgage originations, and any subsequent mortgage that needs to be provided will need the banks to generate deposits. And when the interest rate goes up, deposits will definitely increase, but they may not increase at the same level at which the Fed was buying mortgage-backed securities. So that's going to create a tightening of conditions for eligibility to obtain mortgage and also the ability of the bank to provide mortgage even if it wanted to. Therefore, all kinds of people are going to have trouble getting mortgages. And when that happens, interest rate on mortgage goes up, and also less people qualify for mortgage, less people apply for mortgage, and therefore the purchasing power of the consumer to buy a new home or a resale home goes down. And this can lead to falling prices, falling housing prices. And when housing prices fall, the people who own the house and have a mortgage on the house, they find it less attractive to stay in the house and continue paying the mortgage, because now the mortgage is a higher value than the value of their own house. So they have negative equity in the house. So that's when foreclosures start picking up. And when the bank has got too many houses from foreclosure, the bank is not in the business of buying and selling homes. So it would like to get rid of those houses as fast as possible to get the cash back into its balance sheet. And in that process, what happens is house prices fall further, and that creates more negative equity for other homeowners. So it's a downward cycle that happens. And Fed needs to intervene somewhere out there to bring some sanity and stabilize the prices. So that is one potential aspect of risk that is likely to manifest, may or may not happen, but there is a possibility that it may happen. This is also part of what the market is aware of and is reacting to, trying to get away from this particular risk. And if you further examine the US housing market, Redfin found 2021 rents rose in 48 of the nation's 50 largest metros, with the highest increase in Portland, which was a 39% increase, and Austin, 35% increase. These are all huge increases when you look at it from the point of view of people who are renting. Higher rents are linked to the continuing rise in home prices because if there is a higher rent available, then investors in real estate are willing to pay more to buy a property because they know that the rent is higher. So the ratio between the cost price of the house and the yield from rents remains healthy. That's how it works. It can feed both ways. Higher housing prices can lead landlords to charge higher interest, and higher rents because of shortage of rental units can cause landlords to pay higher amount of money to buy units to rent out. So it can work either way. Household is burdened if it spends over 30% of its income on housing and utilities. This is the common wisdom. Nearly half of all renter households spent more than 30% of their incomes on rent and utilities each month. So this is the statistics that we have. So we are already having more than half of the households stressed by virtue of raising interest. And if you look at this particular chart of US housing provided by the Federal Reserve, and you can see that the house price is at the peak at this point of time. And if we were to look at new residential constructions, you can see that the permits are also equally high. They are falling a little bit. Starts are accelerating, and completions are also up a little bit. But we should also remember that as interest rate goes up, as rents go up and households get stressed, their ability to pay rents is going to diminish, and that's going to cause problems. And when their ability to pay rent is diminishing, investors are going to be willing to pay less for new houses. And also, as more supply comes on board, there is going to be more housing available, and therefore price of houses likely to fall. And on top of this, we have a bit of distraction, which I've talked about disruption, which I've talked about earlier. People from New York and California metros, which are high price property areas, moved out during the pandemic to bigger freehold properties in low cost areas like Florida, Denver, Colorado, Arizona, and other places. And as a result of which demand got stimulated in those areas, and housing prices went up. In response, builders did a lot of housing starts. As you can see in these charts, the housing starts and other things went up. Now they're all coming to completion, and recent reports are that people are going back to New York, and therefore there's going to be some amount of pressure in parts of Florida, parts of Arizona, parts of Colorado, where there is extra housing supply as compared to people who are ready to buy. But overall, it suffice to say that there is a big risk that the housing market in US can go into a downward spiral, in which case the mortgage-backed securities are going to be stressed. And you know what happened last time during the GFC. It was all triggered by the mortgage-backed finance securities, MBFs. So we have to be cautious that we don't get trapped in these kind of things. And that's the mentality of most investors. So there is again a risk of behavior that is going on in the market. Now, if you look at the US housing market statistics, mortgage applications in US dropped 5% in the previous week, a sixth straight week of falls as mortgage rates continue to march higher. The average contract rate on a 30-year fixed rate mortgage increased to 5.2%, the highest since 2010 from 5.13. So the contract rate is basically referring to interest on the mortgage. Higher rates are causing a pullback or delay in home purchase demand as well. Home purchase activity has been volatile in recent weeks and has yet to see typical pickup for this time of the year. This is the background. And on top of it, you remember from our earlier videos, I had mentioned that the real income increase was only 5.5% as compared to inflation of 8.5%. So there has been a demand destruction of around 2 to 2.5% out there. So you have to keep that also at the back of your mind. So overall, from an investor's perspective, it looks like opportunities are reducing and risk is growing in every sector. So people are trying to take their money back, put it into either gold or into bonds. And some people who are still interested in taking risk are going into things like energy. Energy stocks are going up like anything, but whatever goes up has to come down. So there is a risk building on as it keeps on marching upwards. And people who are willing to stay in the stock market are going into consumer staples, which is what most people like to buy, have to buy in order to survive. Staples are like salt, bread, butter, those kind of things which are essentials. Consumer discretionary is suffering because that is discretionary expenses, as the title suggests. So this is the overall configuration of the market. In the midst of all this, the ones that look risky are the likes of genomic shares, where we don't have a product, we are still doing research, FDA may or may not approve. There are various gates of FDA. I have put a earlier video in which I'm talking about how FDA approves a drug or a therapy and what is the success rate in each of those stages. So there are genomic companies which have not yet entered the FDA drug approval stage, so they are going to be under the maximum stress. And the ones which are in stage 1 or stage 2 of clinical trials are going to be the most desirable, because none of these companies have had FDA approved therapy or product so far. The ones that are very close to it are BEAM and CRISPR, and they have got sickle cell therapy which are going on clinical trials, and they are already IND enabled. Those are the companies that are most likely to do better as compared to the other companies in the CRISPR watch list that we have. Having said that, I'm going to come up with a special tomorrow on CRISPR and BEAM, and I'm going to talk about the things that we need to watch out for in their earnings and what gives optimism to the market with regard to these two shares. But having said that, this is what is happening with the housing prices. And if you look at this chart, it shows the drop in mortgage applications. The red bars show you the drop in mortgage applications. So it's not looking great because we got 1, 2, 3, 4, 5, 6 weeks of drops in mortgage applications. And a percentage of those applications will qualify. As interest rate goes up, the amount of people who will qualify, the proportion is going to be smaller. So definitely we can see a dampening in the US housing prices. So that now takes me to the zoomed out view. This was about US. When we zoom out, we can see that there are a whole lot of countries with a high level of debts. And as of February 11, 2022, IMF had total lending commitments around 239.2 billion. And these 5 countries are having the highest outstanding IMF financing, which means they are laden with debt and they need to pay off. So this is Argentina, Egypt, Ukraine, Pakistan, and Ecuador. And you know what's going to happen to Ukraine with the war and all. It's not likely to pay that 9.8 billion and may need further support. And then if you look at the whole list of countries which are likely to default, there is around 42 countries or 50 countries out there which are most likely to default. I don't want to go through the name of all these countries, but definitely whenever these kind of default happens, there are multiple things that happen overall. One is people flee these countries and try to go to better countries for job and economic prospects, and also within the country, because they have defaulted, they are not able to pay the money back to IMF, then IMF will want them to do some reforms. So there is going to be a lot of push and pull happening. A whole lot of people are not going to be able to buy things. And that is going to reflect in global trade, because these countries won't be able to afford to buy many things. And that's going to reduce the global trade volume. And that's how these defaults are going to impact us overall. Now, just to pull it all together and put everything in a sequence, the pandemic upset the apple cart. Lockdowns and supply chain bottlenecks along with COVID support funds caused the inflation because people were not working and not producing. The government gave them money and they wanted to buy stuff which was not being manufactured. So the inflation went up. And when all that happened, we also had the supply chain bottleneck, which prevented goods from being imported. Then we had the Russia-Ukraine crisis, which caused the oil price to hike, causing inflation. The inflation caused the Fed to hike interest rates, leading to lower future value of income and hence a fall in indices. Fear of recession causes money to move into energy, consumer staple, and materials sector, as I explained. US bond yields started rising as more people started buying bonds, creating risk of environment for growth stocks. When the bond yields raise, the growth stock start falling because there is more risk in the growth stocks. Future income is going to be discounted. Interest rate increase along with reverse COVID migration is likely to cause housing crisis in US, as we just saw in the chart and the slides that I spoke about before. Fed tightening, if it includes mortgage-backed security sales, will topple the housing market because people will no longer be able to get mortgages. Banks will not be able to afford to give mortgages. So that's going to be the condition. In conclusion, what I would say is that the genomic stocks are likely to suffer the most along with technology stocks because they don't have products and income in place. The technology stocks will suffer slightly lesser because they already have products in place, but their future income is going to be discounted. Future demand is going to be muted. But among those technology companies, the one which have command over market price are going to be able to save their margin and therefore their dividends, and therefore they will have much better stock prices. Genomic companies with strong balance sheet and advanced FDA pipeline candidates will fare slightly better, as I explained before. Assuming the Fed rate hikes by end of second quarter tames inflation, we can see a rebound. What I mean by that is that if the Fed continues raising interest rates, let us say in May, June, and July, and by July we have falling interest rates and the Fed decides to cool off and decides to just stop its activities, then in the third quarter or by the end of second quarter, we can start seeing a rebound in stock prices, we can start seeing a drop in yields in the bonds and a reverse of all the things that are happening. This is a soft landing scenario. Technical analysis of Nasdaq with above factors in background indicates a very pivotal period ahead. I'm going to show you the chart and explain it to you. If Nasdaq drops below that pivotal level, it would be again likely to go up in the third quarter. This is what seems most likely to me. Okay, let us look at IXIC, which is a Nasdaq, and this is my long-term view. You can see at the bottom, 2013 onwards, we have up to 2022 here, and you can see Nasdaq has been raising steadily, but a very rapid raise from 2020. And this particular raise is in a bullish channel, which we have plotted earlier. And right now we have fallen out of a bearish channel, gone up and come down sharply. So if we were to look at where we are right now, I'm just going to expand this chart so that you can see the lines clearly. So this is the candle that we have for yesterday, and we have dropped significantly yesterday. If you look at IXIC, we have dropped 2.55% yesterday. That's around 335 basis points. And we have fallen below two levels of support. So the first one is this green line out here. And this is at 13,031. And we are going to mark this red. The next one is this green line, which is 12,865. So we are going to mark this as resistance because we have fallen below this as well. And the diagonal line is no longer valid, so I'm going to take this off. So we have our next support as at 12,560. So 12,560 is another 250 points drop. And if I was to zoom out, our next support after 12,560 is 12,106. So there's going to be heavy drops after this. So next week looks pretty dangerous and scary. And I'm thinking that with the tightening of the interest rate and with the housing situation the way it is, and with the Ukraine-Russia war the way it is, the supply chain easing up slowly but not fast enough with the tight labor conditions and everything, we are likely to see the market continue to drop for probably the foreseeable future. And I'm thinking that somewhere around the end of this quarter, we will start seeing some positives, because probably by end of May, we'll get a reading of the inflation being a bit lower. We'll start seeing the inflation turnaround, and maybe by June, we start the Fed looking at reducing its hawkish tone to something more moderate, and that can help the market to sort of bounce back in anticipation of better times ahead. So that's my thought process. Well, what do you think about it? Please like, share, and subscribe, and help us grow this channel. And tune in tomorrow for the BEAM and CRISPR video. It's going to be interesting. Thanks, and have a great day.